Hey, it's 2025. It's a new year. What do you need to know about our new leadership and about the strength of the U.S. consumer and its impact on the economy and the markets in 2025? Let's get right to it. I'm Chris Karam, Chief Investment Officer with Finspire. Welcome to our first quarter 2025 Focus on the Markets video series. And we've already got a full front page. Taylor Swift, she's back again. Actually, in February of 2024, Taylor Swift won a Grammy. And as she wrapped up her Eras Tour, the Eras Tour added $9 billion to the global economy. It shows the strength of the global consumer, willing to spend, willing to go out there, all things Taylor Swift related. How about NVIDIA? What a great story. In June, NVIDIA's market cap eclipsed $3.34 trillion, which made them the most valuable company in the world, surpassing Microsoft at that point in time. October, what an incredible view of innovation. SpaceX landed a rocket. Unbelievable. One of the most incredible things I saw all year in 2024. And then, of course, the unbelievable, unprecedented election season that we went through in 2024. Multiple candidates, multiple assassination attempts. We had it all. It's incredible. Now we're in transition to the second Trump administration. We've got a lot of commentary on that and what's in store for the economy and for the markets themselves. All right, we're going to go through a lot of material. We're going to move pretty quickly. We're on to our capital market strategy board. Let's look at the economy. Growth actually started to accelerate a little bit in the fourth quarter by some microeconomic indicators. We'll see what happens when we get those first release on fourth quarter GDP at the end of January. Inflation is persistent, but there could be a magic potion of productivity that could help it. We'll get into that. Everybody's waiting for the tariffs and trade policies to come through, right? There's been talk about what they are, what they're not going to be. Are they going to be aggressive? Are they going to be blanket? Are they going to be just on certain goods? Are they going to be on certain countries? What's that going to look like? China, Canada have been in the news for a whole host of reasons. My goodness. So that's something we'll look forward to. We'll break that down a little bit. Also, the Federal Reserve, how do they behave? Fewer rate cuts are now expected in 2025. Could keep bond yields elevated, which actually is not a great thing for stocks. It's going to actually increase volatility for the equity market. We'll talk about that. All right, the markets. 2024 was an incredible year, a plus 25% year on the heels of a plus 26% year in 2023. Remarkable back-to-back years of over 20% moves on the S&P 500. That is rare. And so should we expect that going forward? Probably not. But one of the things that we'll look for is where's the diversification opportunities in those non-AI stocks. We're going to get into that because there's some real significant statistics about the non-AI stocks, or not the 490 of not the 10 largest companies in the S&P 500, but the 490 out there where valuations may be very attractive. Okay, politics. You're going to hear the term reconciliation bill quite a bit between now and the summertime. Well, as with anything in Washington, is a reconciliation bill really lead to irreconcilable differences amongst political parties? Probably, but we're going to get into what that means for the economy and for the markets based on public policy. How about the Department of Government Efficiency? That's brand new. Vivek Ramaswamy, Elon Musk started to get into government spending. That could have a huge impact on bond yields, potentially moving lower if the government somehow is able to actually cut spending. I'll believe it when I see it, but there is some momentum in that regard. Greenland, Canada, Panama Canal, we can talk about that, but I'm really not going to save that for this video. Although that thing at the bottom right there, that flag is actually the Greenland flag. I had no idea until it came up recently. Okay, here we go. All-time highs in 2024, 57 of them. My goodness, what was the best performing stock of the S&P 500? It was actually a company called Palantir. You may not have heard of Palantir, but it returned over 340% in 2024. What does Palantir do? They actually a software platform that does big data analytics. So more powers artificial intelligence type movement of analytics. And they serve not only corporations, but also governments. So they've got a big job, and you might hear a lot more from a company named Palantir. The gentleman down below there is a billionaire you've probably never heard of. CEO Alex Karp is the CEO of Palantir, and we'll probably be hearing more from them in 2025. Okay, asset class returns in 2024. I mentioned the back-to-back 20+% years in the S&P 500. NVIDIA is one of the most remarkable stories, market stories that we've seen. It's no overnight success. The gentleman here is Jensen Huang. He's the co-founder of NVIDIA. He's been the CEO since 1993. Really almost unheard of today to have a CEO in charge for over 30 years. Pretty incredible. Now, what's the big difference here? Although it looks really similar, 2023, 2024, almost carbon copies of one another. Big difference is in international stocks, which is this EAFE index, and which measures developed non-U.S. companies. And developed non-U.S. companies post-U.S. election took a negative hit. So that was actually a drawdown experience post-November election here in the U.S. As the dollar got stronger in anticipation of tariffs, trade policies that may hinder overseas companies. We'll see. The market may have some of that wrong. And how they estimate the value of those overseas companies. There may be some tremendous value there. Okay, the U.S. economy. I mentioned the strength of the U.S. consumer has really pushed us through it. It created $9 billion of the Taylor Swift Eras Tour contribution to the global economy. Look, we had 3.1% growth in the third quarter of 2024. It's really solid. 2.5% of that 3.1 was from personal consumption expenditures. That's the fancy economic term for consumer spending. So it was remarkable. In fact, as of November of 2024, retail sales, in-store retail sales grew at 3.8%. E-commerce sales on that same time period grew 9.8% year over year as of November of 2024. Consumers are spending, and they're spending a lot. Why are they doing that? One, things are more expensive. Two, they're seeing wage growth starting to keep up with inflation. So even though the unemployment rate has ticked up slightly to 4.2%, that's still in a lot of economic textbooks viewed as nearly full employment, if not full employment. And with wage growth coming into a little bit more acceptable from an earnings perspective to 3.9%, you're also seeing more productive workers. So in the second quarter of last year, productivity grew 2.1%. In the third quarter of last year, productivity grew 2.2%. Why is this so important? Because productivity helps offset inflation pressures. If you have more productive workers in the workforce, a lot of it could be from this evolution of artificial intelligence. There's plenty of evidence of that workers are now simply more efficient and effective with the growth and the innovation of technology. Well, if you have more productive employees, it actually offsets the wage growth, the inflationary pressures caused by wage growth. So you're going to hear a little bit more from us on that over the course of the year, but that's an important metric that not a lot of people are talking about, but is really important. All right, let's talk about earnings, because this is where could the rubber be meeting the road here real soon with measuring how expensive the U.S. stock market is relative to the earnings generated by, in this case, the S&P 500 companies, the 500 largest companies in the index. All right, we got a lot of moving pieces on this chart, so bear with me. You've seen this chart before. When the S&P 500, noted in the jagged line here, starts to eclipse the earnings mountain, which is in the blue, then that's where you get into potential bubble territory, or where stocks just become too expensive based on the earnings that they're generating. You can see back in the tech bubble in the year 2000, that happened, where we had the S&P 500 line eclipsed the earnings mountain chart. And over here on the right, March of 2000, the forward price to earnings ratio, I'm going to get a little technical on you here, was 25 times earnings on the S&P 500. That was historically expensive. Okay. At the same time, bond yields were at 6.2%. So what did that mean? That meant, could you get a 6.2% bond and hold it for 10 years and get a 6.2% return from the U.S. Treasury? Or would you rather invest in, at that time, more expensive equity market? And it turned out that battle for stocks and bonds was real. Bonds started to win out, and stocks took a fall in 2000, 2001, 2002. What's interesting is that the market also took a tumble in 2007 not because stocks were too expensive, but because we had a big housing crisis and financial crisis. Well, one of the reasons why stocks did so well from 2009, after that mortgage and financial crisis, for 15 years through today was because stocks went down in 2007 and 2008. The thing was that stocks were not expensive. As you can see, they were at 15 times earnings relative to a real bubble of 25 times earnings. And that actually created afterwards, after the excesses of the housing market were restored properly, that paved the way for 15 years of equity market results that were really extraordinary. So where are we today? We're at 21 times earnings, which means stocks are not cheap. They're also not quite in bubble territory like they were in the year 2000. And the 10-year Treasury, from a competitive standpoint, is 4.6%. So this kind of tells you that stocks are probably priced perfectly, meaning that they're probably priced that all their expectations that they that are set in the stock prices, specifically around future earnings, are probably attainable, but they're also probably ambitious at the same time. So in this case, we're probably in a market that, in this case, we could see a drought or a correction, which we didn't get in 2024, which typically means a market goes down 10% or more. And that's not unusual even during bull market periods. Okay, I call this the Icarus chart. And because that's what this picture here is on the bottom right, that's actually a picture of Icarus. His dad, Daedalus, according to Greek mythology, built Icarus wings made out of feathers and wax and said, "Icarus, do not fly close to the sun, otherwise you'll run into trouble." Of course, what did Icarus do? He flew close to the sun. His wings melted, and he went into the water and then drowned. Fell into the water and then drowned. Now, we don't want that to happen, but I call this the Icarus chart because we don't really want that S&P 500 number line to really eclipse that blue earnings mountain. Okay, enough of that. Let's get into earnings and valuations opportunity, because this is a good visual on the left here that you've seen before. Remember, high bars, low diamonds represent the best opportunities strictly from a valuation perspective, not counting other risks. And so by definition of that, you would see, wow, there's some really good overseas opportunities and still some good opportunities in U.S. small companies relative to U.S. large companies over here. Now, what's interesting about that is, yes, there are some valuation opportunities for those diversifying asset classes around the globe and in U.S. small companies. What's even more interesting is that when you dissect this U.S. large company box or U.S. large company space, when you take a look at the top 10 largest S&P 500 companies versus the 490 of the smallest S&P 500 companies, they're all big companies. What's interesting is look at the valuation differences just between the top 10 and the other 490. 30 times earnings in the top 10 versus almost half that in the bottom 490 stocks. And if you recall, on the previous slide, when we said back in 2007, stocks weren't expensive when they were at 15 times earnings and ended up having a great run. Look at this, 15.7 times earnings with those other 490. That tells you that those under 490 could be really poised for a big run as we, not just in the short run, but over the long haul as we look forward, not just in 2025, but beyond. And the incredible concentration of those top 10 stocks in the index is 38.7%. So the other 490 represent the remaining 60+% of that index in investment opportunity. So there are not only opportunities outside of U.S. large companies, but there are also opportunities inside the largest 500 companies in the U.S. equity market. Sometimes you hear the phrase "the Magnificent Seven." I always think of the movie from 1960. I wasn't alive then, but have watched it. The Magnificent Seven, which is now referred to the Magnificent Seven of the largest companies in the S&P 500, which have done exceedingly well, but opportunities are elsewhere. Okay, let's get into the interest rate story. This is fascinating. So in the end of 2024, the Federal Reserve decided to cut short-term interest rates several times, and you can see what's happened to the curve. Instead of going from inverted, which means that there are higher rates in the short end, longer rates on the lower end, now we have flattening and almost an upward sloping Treasury yield curve, which indicates that we could have higher growth and higher inflation potentially looking out to the future. That's what the bond market is signaling. We'll see what comes to fruition. What's also interesting here is that Jay Powell, who you see here on the bottom right, has been the chairman. His term as the chairman of the Board of Governors of the Federal Reserve ends May 15th of next year, 2026. President Trump has said he's not going to reappoint or renominate Jay Powell, so we're going to have new leadership in the Federal Reserve, and we're going to see how that political aspect of the Federal Reserve plays out between now and then. Okay, another important person in Washington. Tax rates. We've mentioned tax rates are scheduled to sunset at the end of 2025, end of this year, and revert back to 2017 tax rate levels, which means higher taxes, if Congress does nothing throughout the year 2025. So amazing spotlight is focused on this gentleman here on the right. His name is Jason Smith, congressman from Missouri. He is the chairman of the House Ways and Means Committee, which is where all tax legislation must begin. So he is going to become very well known you'll see him interviewed quite a bit in the press when you're tuning in to the tax topics, and he's got quite a challenge ahead of him. Do tax rates stay the same? How does the tax code incorporate things like no tax on tips, no tax on overtime, no tax on Social Security, which were all election promises from President Trump. So they have an extraordinary challenge ahead of them, especially in the House, because the margin of error in the House is very, very slim. They can only sacrifice about 1 or 2 votes. The Republicans can if they want to pass through legislation on a party line basis. So he's got an extraordinary job in front of him, and you're going to see more from him. All right. Now, here's an area that I find really fascinating, not just because you hear a lot of talk about tariffs and trade and what countries is Trump going to tariff? He's going to tariff everything from a country, certain goods. What is happening? There's a lot of confusion around that and a lot of opinions. What's fascinating about tariffs is that many years ago, Congress ceded the concept of tariffs to the executive branch. So on day one or week one or month one of the Trump presidency, he could act. He could act swiftly you've heard about him wanting to tariff goods from China at a higher level. Canada, Mexico, he wants to relook at what's happening in Mexico from an economic perspective, especially as it compares or as it relates to things like immigration. And is there a trade-off there of tariffs and immigration, et cetera? All these things are at the disposal of the executive branch of the United States. So the president can make these types of decisions. And based on some of the comments that he's had, we could expect to see some action taken here very early on in his presidency. One gentleman here who's important, you probably don't know him, probably haven't heard of him much. His name is Robert Lighthizer. He was the U.S. Trade Representative in the first Trump administration that originally put a lot of the U.S.-Mexico-Canada agreement to replace NAFTA, which was a big undertaking, and with other countries as well. He's now coming back as the trade czar. Has been asked by President Trump to be the trade czar, which reportedly has a much broader focus and scope than what he had just as the U.S. Trade Representative. So this is another person you're going to hear a lot from in 2025. And this is his second rodeo with the Trump administration. He also served in previous administrations before the first Trump administration as well. All right. Here's a good one. Gold. Gold has been historically a very uncorrelated asset class with stocks, with the S&P, as you see here, S&P 500 comparison here. What's very interesting is that demand for gold has remained very strong. As a matter of fact, it's not just with the central banks around the world, which is driving a lot of demand for gold. How it's also in our local Costco stores. In fact, Costco CFO Gary Millerchip told analysts in the third quarter of last year during a conference call that gold sales were a meaningful tailwind to e-commerce sales in the quarter. Amazing. So gold even be purchased at gold bars at Costco, and from what I see, other forms of metals can also be now purchased through Costco. Remarkable to see where the demand curve is for gold these days. Same with Bitcoin. Bitcoin eclipsed $100,000 per coin. Off the cryptocurrency lobby was very strong in the first real active year they were in the political cycle. They made an impact. President Trump was very warm to the cryptocurrency lobby, and as a result, post-election, you saw Bitcoin value drive north of $100,000. And another person who is in a position of leadership you're going to hear more from is Senator Cynthia Lummis from Wyoming. She has been working on legislation for quite some time now on how to make the rules, the regulatory rules, a little bit more, or how to regulate cryptocurrency altogether and the digital asset space altogether. And so expect to hear a lot more from her in 2025 and in 2026 as Congress tries to properly regulate cryptocurrencies like Bitcoin. All right. So it was quite a year in 2024. I got to tell you, 2025, it's been a bit of a rough start. You probably noticed I'm in a little bit of a different background here. I'm actually in Southern California doing some due diligence with a large fixed income manager here. And real close by, as you know, are these incredible, almost biblically resembling fires that are taking place also here in Southern California. The work of the first responders has been incredible, has been extraordinary. And to see the film of people fleeing their homes and their homes going up in flames so quickly is heartbreaking. It's tragic. But we not only want to thank you just for tuning in, but we also want to thank those first responders. They're the ones who are going in to protect those who are trying to get out. And seeing here on the local news and also, of course, in the national news, what's happening here is extraordinary. So we pray for better outcomes for people here and for Mother Nature to put an end to the fires that are taking place here in Southern California. Truly extraordinary and tragic at the same time. And we hope and pray that that lives are saved and that these fires come to a close very, very, very soon. Thank you for listening. We look forward to all of our conversations with you this quarter and can't wait to see you throughout 2025. Take care.